Happy New Year, everyone. I'm Erin McLaughlin, ACEC's Vice President of Private Market Resources, and this is our monthly less than 10-minute installment covering macroeconomic and private market highlights. So here we are in January 2022. Let's go ahead and get started. And like with many of our videos, we're going to go ahead and start with the construction put in place numbers. So just last week, the first week in January, we got notice on the November numbers. And so what you're seeing now is sort of the year-over-year comparison of November of this year, or rather November of 2021, compared to November of 2020. And this really continues the trend that we had seen all year, which is that, total construction put in place, which includes design numbers, is up over 9%. And residential is really driving that growth. So our residential number from November to the last November was up over 16%. And the private number was surprisingly up 7%, which is the highest monthly number that we had seen in some time. So that's good news. And our public, which had sort of declined after the private during the pandemic recession, has started to come back. It's only down 0.9% year over year. So all in all, November versus November of 2020 showed some great progress. Now the next table, we sort of look at total year over year. So this would be January through November of 2021 versus 2020. And again, we see the same trends, a really significant residential growth of almost 24% year over year that creates a total design and construction number of almost 8% for that same time. And then we see that private non-residential was down about 3.5%, and public was down just over 4%. So again, this is very much in tune with the trend that we predicted way back when this recession began, that we would see private, commercial, real estate, and building spending sort of decline first, and then we would see public decline. And then, of course, no one expected this incredible residential boom, but it is still happening. Now, the economy is pretty hot, as we all know. So what we're looking at now is just sort of a line chart that shows that growth. So, our total number is really mirrors almost the private number, while our public number remains flat. Now, we do expect this to change with the passage of our infrastructure bill this past November. And as monies are allocated and spent and move out into projects, both public and private projects will receive funding as a result of the infrastructure package. We expect, our trend lines to remain going up, and perhaps our public design and construction number will increase pretty significantly, as it has been pretty flat. Now, in this month's installment, we're going to dive a little deeper into labor and unemployment. We are hearing from our ACEC members, and we are very much aware that the labor crunch is really affecting us, and it's affecting almost all industries. So what was really remarkable about the December employment numbers just came in this past Friday, January 7th. And we saw the unemployment rate dip below 4% for the first time since pre-recession, pre-pandemic. And, that's really, really key. And it is the most rapid decline historically in the last 6 months that has been seen in decades. So what also is a trend, of course, goes back to supply and demand. We've seen yearly wage growth increase 4.7% last year. Now, for all of our members that have built into their contracts 3% if that escalations for the next few years, this is not good news. And so this is really important for us to sort of be very mindful that this incredible labor trend of not being able to find workers, but combined with that raise in wages, is having an extreme impact, especially on an industry like ours, where our product is our service, is our people. So, when it comes to wages and wage growth, higher wages basically can, translate into increased demand. People have more money to spend, which then feeds into our inflation issue with regards to a surge in prices. So a little bit, Econ 101, we'll go back. What is the role of the Fed and how is this all being treated at the federal level? So, as many of you may be aware, but maybe some of you aren't, the Fed has sort of what's often called a dual mandate. And it is supposed to promote effective monetary policy to create an environment of maximum employment, also encourage stable prices and moderate long-term interest rates. So when we think about that and we think about the environment we're in, and we think about all the stimulus that they fed into the economy back in the early days of the pandemic, we're going to see some changes. And we might see changes faster than otherwise were thought. So as a result of what many people, the concept of maximum employment is, certain people have different concepts of what that is, but 3.9%, if we're not at it, we're very close. So we do expect that the Fed, when it meets at their policy meeting in March, will begin to raise interest rates from near zero. Now, this will, create less of a potential for overheating, and it will also moderate possibly some of the demand in the, obviously the design and the building sector. We also anticipate that they will sort of taper off what's called their bond buying program. And they were, projected to do that in June, and they may sort of bring it forward and begin to do that in March. Now, we definitely know that we're not imagining this inflation. We're not imagining these price increases because the core consumer price index has shown that for our most recent data in November of 2021, we're up 4.7% from November of 2020. And this is well above the Fed's target of 2%, although even the Fed has admitted, the target maybe should be a little bit higher than 2%. So, there are several factors that sort of go into this and remain a concern. One of them is the supply chain. If the supply chain is still an issue, how does that factor into it? However, there are lots of signs that the supply chain is easing, and many analysts do expect it to ease continuously next year, or this year rather, in 2022. And then new variants. Every time we think, things are settling, consumer spending's back up, things are returning to normal, we get a new variant. But the Omicron variant appears to be in full swing. I'm sure many of you have had it. Many of our friends and family have had it. And it doesn't seem to be having the mass impact on the economy or even on unemployment and demand that we would have seen previously. Thank goodness for vaccines. So connected to that, the other real sort of concern or factor in all of this is vaccination mandates. So will both public employers, private employers, and others mandate and be able to mandate vaccines? And if they do mandate vaccines, some states, especially those that are right-leaning, have decided that they may allow workers to then claim unemployment benefits. So, most analysts and economists are keeping an eye on that situation to see how that may, put any wrinkles into the next few months. But so far, there does not seem to be a big impact in unemployment numbers related to vaccine mandates. So with that, I'll, point you all to our fabulous website where we have a page that is dedicated to all of the analysis that we're doing around private markets and the economy. We also are ready to have our second commercial and residential real estate private market symposium in warm Scottsdale, Arizona, the first Thursday evening and Friday in March. So we hope you all will check that out and think about coming. And if you have any questions or there's anything in particular you'd like us to look into or to think about, drop me an email or a phone call. Thank you.